I'm Matt Staninger, Market Research Analyst here at Oak Street Funding, and joining me today is Steve Blake, Senior Managing Advisor at Evans May Advisory. Steve, thank you for being here today.
Thank you, Matt. I appreciate you guys having me.
So thinking from your role as a CPA, for the rest of the year or even going into next year, how should small or mid-sized businesses be impacting or changing their strategy?
So I think because there are so many changes here, I think I kind of mentioned earlier, this bill is 870 pages. The summary is 56 pages. There are probably hundreds of changes within this tax bill, all of which kind of impact each other. There are phase outs, so we could talk about the increase to the child tax credit, but who gets to take that? We can talk about tips or tax-free, but who gets to take that? Because it depends on your level of income. So what I would tell you is all of these things kind of interplay together and really impact what your net tax number is. So what I would say is because there are so many changes, it's hard to look at any one change in isolation. What I would recommend doing is a multi-year projection. So starting with what you think book income is going to be this year, and then using very sophisticated analysis in order to look at what are the tax implications of all of these changes. And then, okay, what are some of these changes that you want to maybe implement? So there are changes to the rules about employers paying off student loans for their employees. There are changes related to various benefits for employees, child care paid for by their employer, those types of things. So in addition to just looking at, hey, if we just keep doing what we're doing, what's the tax impact going to be as a result of all of these changes interacting together? But also what came out of this bill that we might want to take advantage of? You know, what are some of those benefits that we get a deduction or a tax credit for? Any energy credits that are still available? What are the deadlines for some of these changes? So is there something we can do? Some of these changes go into effect September 30th. Some of them go into effect January 1st. Is there anything we can do before these deadlines come into play? And really take a full comprehensive look at the total impact of all of these changes and see what can we do before September 30th, before December 31st? What do we want to do next year? Like I said, do that multi-year projection and see how is this going to impact us from a tax projection standpoint, a tax implication, but then how do we want to also implement anything that came out of this bill that we might be able to benefit from?
With it being such a long bill and there being so many provisions that could really affect different businesses so differently, what advice would you give to current CPAs on their phase-in for the adjustment period for their roles?
Yeah, that's a great question. So a lot of what we're doing in our industry is really trying to digest the bill at this point because there were changes being made to it up until right before it was signed. So just making sure we as CPAs have a full understanding of all of the provisions within the bill and how those impact our clients for this year, next year, and the following years. Because we talked about some of these provisions being made permanent, but some of them were just extended. So some of these provisions are only good through 2028. Well, what happens in 2029 and how do we need to start planning for that today? So really just trying to make sure as a CPA, we've got our hands around the full implications of the bill, how it impacts our clients. How do we even put these things on tax returns? How does that work? And then how do we explain it to our clients? How do we present it to our clients in a way that will help them understand it? But then for some of these new issues, some of these new things that were within the bill, well, how do you even go about doing that? If we want to create a Trump account for one of our clients' kids, well, how do you do that? Where do you go? There are companies out there right now that don't have the answers to that. So some of this is just going to take time. Because, for example, a company that does IRAs that's going to eventually have these Trump accounts, well, those don't exist yet. So a little bit of this is going to take the next couple of months for all the industries that were impacted to try and get all their processes, paperwork, rules, regulations, all of that in place to help everybody be able to even implement all of this. So some of this is also from a CPA perspective, just being able to talk through from our clients and working with our local professional networks on, hey, you guys handled this particular issue that came out of this bill. Where are you at with implementing that? What do you think the timeline is going to be? How's that going to work once you implement it? Where are you at in those discussions? So just making sure we're working with our professional networks to know, so we can then convey to our clients, hey, this is what we're hearing in the marketplace. This is how this is going to work. And we can help you through that process once it's ready to be rolled out.
So it's a continuing adjustment right now, a continuing preparation, and expanding that knowledge and education base while you can as things continue to develop.
Yes, yeah, very much so, yes.
Great. With this, it of course has congressional approval, it has presidential approval. Would you anticipate there to be any judicial review that could have upcoming changes as well?
That is a great question, because we do see a lot of challenges in the court system to a lot of things the executive branch has been doing over the last several months. But typically with something like this, where you actually have a bill passed, the only real challenge that can be made is whether or not a provision violates either the Constitution or an existing law that would somehow prevent that from being able to be implemented. Typically speaking, with tax provisions, you're not going to run into a lot of constitutional issues. I can think of a couple off the top of my head in the last few years that got challenged based on constitutional grounds. And typically the court will defer to Congress on those types of issues unless there's just a real blatant violation of the Constitution. So I don't really see a lot of court challenges coming out of this on the face of the bill itself. What we could see is, as this is rolled out and we see how it impacts various industries, those industry groups might try to mount a challenge to certain provisions of the bill because they're being treated unfairly under the provisions of the bill. And I'll give you an example of that. With a bill several years ago, there was a provision that specifically impacted dealerships. So, and especially RV dealerships, when you're talking about towable trailers versus RVs or motorhomes. And there was a legal challenge to that provision that ended up actually failing in the courts. But that's where you tend to see those types of challenges, is if an industry is hit specifically hard by a provision. And a lot of times it's an unintended consequence. It's something Congress didn't realize or think about until everything kind of gets rolled out. And then these industries start jumping up and waving their hands and going, hey, do you realize what you just did to us? And then a lot of times Congress will come back, sometimes even with, I've seen even a one-page bill that just fixes something for a particular industry. So a lot of times when that happens, the easiest way is to just get Congress to pass another short bill that fixes a particular issue, if you can get them to agree to it. Because typically speaking, those court challenges, they make great headlines, but typically speaking, they don't have any real impact.
Great. What business moves would be strategic to take during the second half of this year with the tax changes in mind?
So I think if we look at it from a business perspective, we've talked a lot about the 100% bonus depreciation. We've talked about Section 179, the R&D credits, really trying to get the economy going, spending money. And so I think from a tax benefit perspective, a lot of these things have been made permanent. So from a timing perspective, maybe there's not such a huge difference between this year and next year. But if it would help your business, maybe you go ahead and incur some fixed asset costs, some R&D costs, get some of these things going now, knowing that you at least have that tax benefit now, because as we all know, Congress changes over again in another year and a half or so. So we could have another tax bill at some point that might change what we currently have available to us. So you never know what the future holds, but we know what the tax code is right now. So if there are things that you can benefit from now, it's probably wise to take advantage of those.
Right. So we talked a little bit about R&D, some of those fixed costs. How about the M&A market? How should this be affecting the M&A market?
Yeah, so a lot of the provisions in the bill, I don't know that there was a big impact in the M&A world. Obviously, the tax rate staying low helps. Some of the provisions that got extended help. On the buyer side, obviously the bonus depreciation, the 179 extensions, those really help, because as you're buying those businesses and you're putting those fixed assets on the books, you get those deductions right away, which helps offset your cost to purchase the business in the first place. So there are some provisions on the buyer side that will definitely help. On the seller side, probably just the tax rates would be a big benefit. Those not going up will definitely help. There was no change really to the long-term capital gains rate. That was one of the things that was being negotiated, was increasing those capital gains rates. That did not change. So on the seller side, that definitely helps. So now might be a good time if you're looking to sell. It would be a good time from a tax perspective for both buyer and seller.
And we should expect a few more years of that current condition.
Yes.
One of the provisions that had changed with this new bill was the interest expense deduction. So what are some of those things that could affect individuals that may affect the insurance agency industries?
So yeah, as the tax bill relates to various interest deductions, there are a couple of different provisions that come into play. One relates to new vehicle interest. So up to, I think it's $10,000, and you meet certain income requirements, and there's a couple of rules in play here, but basically you get to take a deduction for the interest you pay on purchasing a new vehicle. That's something that's never been allowed in the law before. So when you ask about new provisions, that's definitely something that's new. The other one that I can think of off the top of my head that relates to interest is when it comes to mortgage interest. So one of the things the Tax Cuts and Jobs Act did back in 2017 is it reduced the amount of mortgage interest that you could take. But that provision, again, was one that was going to expire. Well, this new bill extends that. And so there's a continuing limitation on the amount of mortgage interest you're going to be able to take. So it's been the same for the last 7 years or so, and it's just going to continue. But it's the fact that it's not going to expire is really the change there.
One of the large provision changes was around the estate and gift tax area, which could impact our RIA clients. So can you give a summary about that estate and gift tax provision?
In terms of the estate tax, one of the things that was done with the Tax Cuts and Jobs Act is it really increased the lifetime exemption. So the lifetime exemption is what we use when it comes to gift taxes, so giving something away while you're alive. And then when you pass away, there's the estate tax, so whatever passes on to your heirs, your beneficiaries. And so that exemption from tax had greatly increased under the Tax Cuts and Jobs Act. And based on inflationary increases to the exemption, it was, I'll call it 13.7 million. I forget the exact number. But what this bill did is, because that provision was also going to expire. So starting in 2026, we were going to go back down to the old exemption. And so people that have large estates were going to end up paying a lot more in estate tax. And one of the things this bill did was it increased the exemption to 15 million and made it permanent in the law. And then that 15 million over time increases based on an inflation index. So definitely from an estate planning perspective, this is a huge win when it comes to people that have large estates. They'll be able to do more gifting while they're alive, pass on bigger estates with no tax implications after they pass away. And then now is probably a good time, if they hadn't done it under the Tax Cuts and Jobs Act, to try and put some kind of planning in place for their estate to make sure they're fully utilizing that increased exemption. Because while that's made permanent in the law now, as we all know, new Congress, new president, things could change.
Thank you, Steve, for being here to discuss taxes with me today, and thank you to those watching. For more information and access to free resources, visit us at oakstreetfunding.com or call us directly at 866-625-3863 to start a conversation. Let us help you navigate the evolving lending environment and secure the capital you need to thrive. Thanks for joining us on Point.